You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Welcome back, or should I say I am back. So 2 weeks in Iceland. I'm gonna share some details of my trip this Friday. But in the meantime, I took one more day off yesterday, just because if I don't feel like recording an episode, I don't think you're gonna get the best value out of it. So better off skipping one and then coming back full strength, very highly motivated to press on that record button and get going. So before I left, I recorded 3 parts of a 4-part series on the best stock per sector. Today, we have 3 more sectors to review: materials, REITs, and utilities. If you have missed that series, that happened last week on Monday, Tuesday, and Wednesday. Sorry about that. So let's get into it. So material sector, definitely not one of my favorite sector, mostly because of the same reason I don't like energy too much. Most of those companies, their income, their revenue, their entire business model depends on one thing they have zero control on, and it's the commodity price. So in this category, it makes most of those companies very poor dividend growers. Most of them will skyrocket and then eventually get into more debt, cut down their dividend, and cry and die if the commodity price goes down. There are a few exceptions to it, though, and those are the ones that are on my list. First, let's get started with the one that is the most, I would call it exciting, but at the same time, highly volatile, and I'm not convinced it would fit everybody's portfolio, and it's Nutrien, NTR. I've covered Nutrien a few times in the past on this podcast, so you can go back in the archive. So I used to hold Agrium back then, but I was not super pleased with the merger with Potash, because Potash was a pure play on fertilizers. They had to cut their dividend back then when fertilizers price are down, and it's pretty much the case right now. So I'm not saying that Nutrien will have to cut down their dividend, but they are suffering. So revenue and earnings are going down because price of fertilizers not doing well, so therefore Nutrien is struggling. So not too long ago, it was the opposite. It increased its dividend a few times, and now they're just like, yeah, that's a pretty tough place to be in. So we don't know how long it's gonna happen, but it is one of the largest fertilizer producer in the world. So definitely a leader in the market. So if you want to go on a roller coaster, maybe you should add it to your list. 2 other companies that I like because they are streamers. So they hold assets, mostly like land and mines, and they let other companies extract and exploit those mines, which is great because they receive a royalty fee on all the revenues the other companies are making, which is great for them. Both of them do not have debt, so I just combined those 2 stocks. One is Labrador Iron Ore, LIF.TO, and the other one is Franco-Nevada, FNV.TO. And Franco-Nevada trades on both Canadian and US market. So similar business model. One is about mostly gold. The other one is about iron, Lebanon iron ore, like, did you get it? and most of them, most of the time, they will generate some generous dividend. LIF offer a variable dividend, so do not be surprised if it goes up and it goes down. It simply follows the iron price. And for Franco-Nevada, they have a long dividend growth streak, one of the longest in this sector. So an interesting pick if you want to add some commodities, but you want to have a little bit more stability instead of being dependent on price fluctuation. The other 2, I'm going to go very quickly because I've covered them several times. Those are Stella-Jones and CCL Industries. So for Stella-Jones, what I like is that they are well diversified by offering utility poles, railway ties, industrial lumbers, and then residential lumbers. So of course, lumber price will have an impact on their business model, but it will be a little bit less because when you are working on big infrastructure project, you need utility depots, you need railway ties, and regardless of the price, they will have to happen. So a little bit protected from the construction industry. For CCL, they are dependent on the commodity price to generate their product, but mostly they are creating packaging and label solutions. So they could manage to increase their price as well. They have been a long-time dividend grower, so this is why it's on my list. If you want to find more companies like this, companies that are showing strong business model, revenue that are growing, earnings that are growing, and of course, dividend that are growing, I update a list at moosemarkets.com/rockstars. It's obviously the Rockstar list. Every month you're going to receive an updated list with all the companies on the Canadian and on the US side that are showing a positive dividend triangle. So revenue, earnings per share, and dividend growth that must be positive over the past 5 years. It's not a close your eyes and pick any stocks from that list and you're going to be rich type of thing, but it is a pretty solid starting point for your research. Now, moving on to the REITs. REITs, there are a lot of opportunities there. They have been beaten up pretty much, right? Favorite one, and this one not going to be a secret, Granite REIT. Very frustrating holding right now. I'm down about like 15-20%, excluding the dividend. I've already discussed that on the podcast not too long ago, but still all the metrics are growing. So more funds from operation, more revenue, more FFO per share, more dividend, and a low payout ratio. So I'm holding on to this one because I really like how they are handling their properties. A few others. And I really focus on only REITs that are able to increase their distribution. So CT REIT, Canadian Tire REIT, CRT.UN. This one, well, super big exposure to Canadian Tire, of course, but they have been able to be pretty stable and increase their dividend every single year for a while. So I really like this one too. Another subsector in the REIT that I really love, and I think is a little bit more stable, is probably the apartment REIT, especially now that interest rates are higher. It's tougher than ever to buy a house. So apartment REITs such as Canadian Apartment REIT, CAR, or Interrent, IIP.un.to. They show great profile. They have been able to increase their rent steadily. They show high occupancy rate, so those could be interesting on your list too. Another one, if you are interested in picking a small cap / roller coaster ride type of REIT, could be NET, Canadian Net REIT, NET.un.v. Definitely this one, do not put too much money on it. It was growing very fast by a lot of acquisition when interest rates were lower. They were showing FFO per unit growth like double digit. Now all this story has slowed down big time. They're not struggling because they have like very high quality tenants such as grocery stores, some Tim Hortons, Suncor, Loblaws. So that's pretty good. But due to the fact that they are a small cap and they are only active in a few provinces, they do not have like a lot of properties. They are still at risk of like a recession or any other economic slowdown. So just proceed with caution on this one, but it shows an interesting yield. So that could be interesting if you are looking for a swing trade. This one should be on your list. We're going to have to be a bit quicker than I wanted with the last sector, utilities. For utilities, I got burnt with Algonquin a few years ago. Now I'm going for the safe stuff a little bit more. So Fortis, definitely the mother of dividend growth in Canada. Second longest dividend growth streak behind Canadian Utilities, but they definitely have a stronger business model, well diversified across Canada and the US, more than 50 years of dividend increases. So I really like this business. The other two that I like are Brookfields, so Brookfield Renewable and Brookfield Infrastructure, so BEPC and BI. PC. Those, of course, a lot of like roller coaster. They're less stable in terms of stock price, but they show a lot of growth potential. Management keeps on saying that they're going to keep growing high single digit. So that's going to be very, very interesting. And I'm going to leave the last one on my list for tomorrow. We're going to talk exclusively about Hydro One, a utility that we all forget about, but kind of like an hidden gem in this section. So stay tuned for tomorrow because I'm going to tell you a lot more about Hydro One. In the meantime, do not forget to get your Rockstar list at moosemarkets.com/rockstars, and we're going to talk again tomorrow about Hydro One. So until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.